What's up, traders? Thank you so much for clicking on this video. I really appreciate your time. I appreciate you all for being a part of my journey, so thank you. Go join our free Telegram group where I'm sending trades and updates. The link is in the description below. It is free, so go and join. And we are live streaming here on YouTube live Monday through Friday, 9 a.m. Eastern Standard Time to 10:30 a.m. Eastern Standard Time. Come and have a good time and trade live with me. I'm going to show you my go-to setup and approach that has been pretty solid for me. As I bring up my charts right here, I'm going to go to like USD JPY. I haven't been trading this one at all. I've been really focused on euro dollar this past week on our trading challenge. But what I will do is if I'm taking entries like off of a certain time frame, like 15-minute, 5-minute, 1 minute, let's just say that we're going to go 15-minute for this example, because this is the setup that I actually hit this week, and I'm curious to see how often it does pretty well. So what I'm going to do is I'm going to go back in time as far as my free trading view plan lets me. So this is how you would backtest if you have the free trading view plan. So if you don't pay for it, that's fine. If you pay for it, you could go further back. That's totally cool. But I'm going to go as far as I can, and I'm going to drop a vertical line right here on my charts. And from here on, this is where I am allowed to like look for entry opportunities and pretty much look to see what the 4 hour and higher time frames and up are doing, right? So from here, what we want to see is if we go back in this area right here, I'm actually going to open my Notion trading journal, and I am going to create a page, an empty page. I'm going to call it the 4 hour EST candle power of 3 setup. That's what this is. Okay. That's what we caught this last yesterday actually. So right here on, let's just say that we start from right here. Okay. We start from right here. What is price doing? Am I lagging? I feel like I'm lagging kind of heavy. I'm gonna refresh my chart really quick. I'm kind of lagging. Oh, this McDonald's Wi-Fi. This Wi-Fi is straight up McDonald's. Or is that Walmart Wi-Fi? Everybody's on it. You know what I'm saying? I'm sure making fun of my Wi-Fi. All right, so we still got that vertical line on our charts. Yes, we do. All right, so let's go back on the 4 hours. So the 4 hour is going to be our higher time frame, okay? And what we want to look for on the 4 hour is we want to look for external range liquidity, internal range liquidity, external range liquidity, right? Where is price headed towards as the next draw liquidity? Well, if we notice from here, price retraced into this and then it began selling off, right? And then it targeted external range liquidity. Price was also holding these lower highs and breaking and making lower low wicks, right? And so in this scenario, even whenever price runs that external range liquidity, you continue to hold this bearish bias until you get like a 3 candle wick swing low. That signifies that you're about to have like a little retracement. But even right here, it didn't even retrace, it just keeps going down. So if we just say, for example, what we would look for as soon as price comes into like internal to external range liquidity is we look for 15-minute market structure shifts bearish. And whenever that happens, and if it's going up, you would look for it bullish. But whenever that happens, whenever you get it confirmed, then it means that the 4 hour is starting to flip bearish as well. And that's whenever you start looking for 4 hour power of threes, open, high, low, close, or vice versa. So right here, 3 candle wick swing lows right here. Price takes out this one whenever it taps into it. Where you want to look at is the very first point of tappage. So as soon as price taps into it, where's the most recent 3 candle wick swing low? It's way down here at this swing low. So you want to, and every time price creates a new one, you just want to keep track of that one. So for example, right here, I'm telling y'all, this is a go-to model right here. And then you have this one right here. And price closes below that one, right? With this right here. And then it retraces, comes back, and then it comes. So this becomes like a long-term high after a market structure shift, okay? Now, if this is a valid market structure shift, this long-term high should never be ran out. If you drew a fib level from here down to the market structure shift point, which is right here, you could argue that price gave you an entry opportunity because it came into premium price. And within that area, you have this up close candle as somewhat of a bearish mitigation block. You know what I mean? And price didn't come fully into it, it doesn't look like. But if you drop to the lower time frame, like the 5 minute within this leg, there's likely going to be fair value gap or an order block or something like that. So if there isn't a PD array on your higher time frame, drop just one more time frame lower and you'll find a PD array within that. But right here, you'll notice that the long-term high ends up getting ran out. So whenever the long-term high gets ran out, you just restart as far as the market structure shift leg goes. So once it gets ran out with this high right here, I'm going to go look again. Where's the market structure shift 3 candle wick swing low point? It's right here. And then price creates another one right here. And then this right here is where price actually breaks it, closes below it. So now that it closes below it, this becomes your long-term high, and price should not close above that long-term high. And what I'll always do is I'll draw a Fibonacci from that level, and I'll go to the Fibonacci, or not the Fibonacci. So my point A will be at the long-term high because this now becomes a long-term high. And I will draw my point B to the 3 candle wick swing low that starts the retracement back up. And you can see, what does it retrace back up into? It retraces up into this breaker block right here. So we can take an entry position off of that short, and this would be the low risk sell right here. You would put your stop loss above the long-term high because, again, if price is truly bearish, that long-term high should hold. And so right here, we enter on this position, right? And I talk about dollar cost averaging a lot too. Dollar cost averaging is really cool because if you are comfortable with risking 1% and there are like two PD arrays, or like there's two price levels you want to enter at, or just say that price gives you the opportunity to enter at an even higher price for a smaller stop loss, offering you a bigger risk to reward. Well, you could take your 0.5% right here, right? If you're comfortable with risking 1%, split it in two. Take your 0.5% position right here on the initial tap into that uh, breaker block right here. And then your second position, as soon as price comes up even deeper into it, you can see that we took that entry right here at the 50% level, which is premium price, yes. And then it came into optimal trade entry, which is 61.8. And I like optimal trade entry. So you could take your second 50% right here and you could place it above that same swing high, right? And look at 23.3 pip stop loss versus a 17 pip stop loss. And what you're going to do is you're going to hold this one for a 1 to 2R, and you're going to hold this one for that same take profit price as your first trade, because we anticipate that this one's going to hit, right? And if it doesn't hit, then this one doesn't hit, and it's okay. We lost what we were comfortable with risking. But if and when this one hits the 1 to 2 and this one hits that same price level, this one's going to hit a 1 to 3. So you'll be up 1.5%, up 1%. So instead of just risking 1% here and being in profit 2% in total. Instead, you won what 1.5 plus 1, 2.5%. So you're up an extra 0.5% by allowing that dollar cost average. You know what I mean? And sometimes price won't always go deep within that. It'll sometimes like even from there, sometimes it'll just melt after your first entry. It won't give you a second entry opportunity like yesterday. Yesterday I got my first entry and I tried to scale in on the lower time frame and it just melted. It didn't give me any entry opportunity. But right here now, this is your low risk buy, right? And this actually becomes an intermediate term high right here too. So an intermediate term high is because it turtle souped right here. You can see that it turtle souped this swing high right here. It has a 3 candlewick swing high to the left of it that's lower than this 3 candlewick swing high. And so you can anticipate a new 3 candlewick swing high to form to the right of it. And if it holds it, this becomes an intermediate term high. And what we can do in that scenario is we can actually drag our stop losses to there and we can lock in way less risk because truthfully, if price is really bearish, then that intermediate term high should not be ran whatsoever. So that's what I would do in this scenario is I would move my stop losses right here to this intermediate term high as soon as this 3 candlewick swing high got confirmed right here and it started breaking and making lower lows right there, right? And so now that price has created this intermediate term high and price is now bearish, you know, what we do is we look for that 9 a.m. Eastern Standard Time 4 hour candle. And I talk about Eastern Standard Time because we trade New York Eastern Standard Time. Okay. So on your charts, set your time to New York and look at that 9 a.m. Eastern Standard Time 4 hour candle. So what we anticipate is we anticipate for it to open, high, low, and then close off, right? Or what it will do sometimes too is what it did here. So it opened and it barely wicked up, which we don't look for anything like that. But what it did was it just expanded right away. And why did it expand? Well, because it made this intermediate term high. It respected this optimal trade entry. It respected this bearish breaker block. And it's within this 4 hour PD array area. You know what I mean? So there's many reasons as to why this actually respected here. So once it starts moving away, price will have a retracement eventually, but sometimes it's not really much. You'll see right here, actually, it has barely even anything. Boom, boom. Price actually comes up, taps into here, right? And this is the same 4 hour candle, and it just begins melting again. So in this scenario, it didn't really give that retracement that we want. We want to see it retrace kind of deep into like optimal trade entry again, and so on and so forth, right? So this candle just kind of melted, but what we also look for is we look for the silver bullet, which is the second stage of distribution of that market maker model, right? So if we have this low risk low risk sell right here, and then let's say that this right here is your first stage of distribution because it finally had this retracement right here, first stage of distribution, and then price retraced one more time into this PD array, and this would be your second stage of distribution, and this would be your silver bullet. We call this taking candy from a baby. Why? Because we're already so close to the next draw on liquidity, the 4 hour external range liquidity, that it's kind of ridiculous for price to even come way back up here. There's no reason for it. It like the algorithm would much rather just chase the next draw on liquidity that's closest to it, which is right here. So again, what we can do is you can look the way that I like to apply Fibonacci is the 3 candlewick swing low that starts the retracement. I look for the most recent 3 candlewick swing high from that, and you can see it's right here. And I'm gonna place my fib point A from that, and I'm gonna draw it to that, and you can see we actually came up into that optimal trade entry premium price, and this is going to be the first stage of distribution. And then what you can do from there is you could drag your fib right there to that next point, boom boom boom, and you can see that it came back up into optimal trade entry again. And what's really cool is if you are really interested in dollar cost averaging like I am, is you could use Fibonacci retracement levels as dollar cost averaging levels. So for example, you could place your first entry, let's say that you're comfortable with risking 1%, place like split it up into 3 different entry positions. So you would do 0.33%, and you would place one at the 50, one at the 61.8, and then one at the 79. So as I do this right here, let's just clone that, and let's drag that one to the 61.8, and then let's just clone that one, and let's drag that to the 79. And then they're all going to go above the same swing high right here all the time. That's going to be your stop loss every single time. And what you do is for the entry that was at the 50% level in premium price, that started premium price, you're going to target a 1 to 2R. And that same price, which you'll notice that it lines up with the negative 50% on your Fibonacci. And if you don't have your Fibonacci set up like mine, this is how I have it set up. I have the 0, the 0 0.236, 0 0.5, 0 0.618, 0 0.791, and then I have the negatives, -1, -2, -1.5, -0.5. Okay. And I just use one color. You could like do all kinds of different stuff. You could really mess with it however you want, but I just do the one color. So look at this. What you would also do is you would set your other take profits for that same price level as your first one, because if we enter this position, we expect the 1 to 2R to hit. And because they are all the risks that we are comfortable with risking, we're going to set them all for that same price level here. Boom. And you can see that this becomes a 1 to 2 plus a 1 to nearly 3 plus a 1 to 6. Okay. So sometimes this one don't get triggered. As you can see, this one did not get triggered on this setup right here, but these two did. And that still offered you really good profit in return versus if you just threw in your full 1% on just the one trade setup. You know what I mean? It's very interesting the way to go about it because you can't predict, but I feel like this is one of the best ways to protect your capital and all of that good stuff, and like really prevent from what is it called, like bleeding your account. So right here I would be in this setup, and this would be the silver bullet entry model right here. But again, this actually happened during 19, which is what, 13 is 1, 13, 17 is 5. This is 7 p.m. Eastern Standard Time right now. So I wouldn't even be trading actually. But you can see how price actually moves during these times too. This was all of Asian session right here. And then it had this expansion towards that silver bullet external range. And what you would want to do is you would want to actually like journal this. And the way that I journal it is I have my journaling template right here, and I will go ahead and just copy it. Boom, copy. And I'm going to go here and I'm going to add a page inside of here, and I'm going to paste it, right? And so pair name USD JPY, and then like I'll fill all of this out, dude. But truthfully, this actually wasn't a 4-hour Eastern Standard Time candle power of 3 setup. This was actually more so a 4-hour into 15-minute market maker sell model into a second stage distribution silver bullet setup. So I would correct like those kind of things and whatnot. But how long is this video already? 19 minutes. I don't want to make it too long. If you guys truly want to see how I journal, because this kind of becomes the boring part. And I don't want to bore you guys to death. You know what I'm saying? I don't want to bore you guys. What the heck? Who wants to be bored? Not me. Not me. You know what I'm saying? So like if you guys want to see how I journal, see how I trade all of this live, because I allow my intuition to take place in a lot of these trade setups too. And I feel like my I can trust my intuition at this point, which is nice. If you guys want to see that, come join me Monday through Friday, 9 a.m. Eastern Standard Time to 10:30 a.m. Eastern Standard Time. We are live here on YouTube. I'm excited to do it, dude, because all that pressure, I love the pressure because I'm a diamond. I'm getting formed right now. You know what I'm saying? If you got some value from this video, drop a like. Thank you guys so much for watching and being a part of my journey. Subscribe if you aren't already subscribed and click that bell so you know when I upload. We'll see you guys later. Have a good day.